While amateur traders panic sell at support or chase breakouts that fail, the smart money is systematically building massive positions inside what appears to be a dull trading range. These accumulation boxes aren't random. They are carefully engineered by institutional operators to absorb supply without moving price. Once you understand how to read the footprints of large-scale buying with these ranges, you'll never look at sideways markets the same way again. For example, notice how the stock oscillated between $47 for 6 weeks. Most traders got bored and left. But look closer at the volume. Spikes on down moves near 47, heavy volume with no further decline. That's absorption. The whales were catching every share the public threw at them, hiding their buying behind manufactured weakness. The breakout to 68 wasn't luck, it was inevitable once accumulation completed. Let me explain something that will transform the way you view markets forever. When you see a stock trading sideways, moving between defined boundaries for weeks or months, your first instinct might be that nothing is happening. The public thinks these periods are dead money and moves on to chase something more exciting. This is precisely what the large operators want you to think. What you're actually witnessing is the most important phase of the entire market cycle, accumulation. The trading range, or what I call the accumulation box, is not a period of inactivity. It is a carefully orchestrated campaign where the composite operator, the combined force of large institutional interests, is systematically buying every share they can without driving the price against themselves. Think about this logically. If a powerful banking interest or investment trust wants to acquire 50,000, 100,000, or even several 100,000 shares, can they simply march into the market and buy it all at once? Of course not. Such buying would immediately send the price soaring, forcing them to pay increasingly higher prices for their position. This defeats the entire purpose. Instead, the composite operator must be patient and cunning. They construct a box, a horizontal trading range with clear support below and resistance above. Inside this box, they conduct their campaign of accumulation over time, allowing the public to sell to them willingly. Here's how you identify these zones. First, observe the price action. The stock oscillates between two clearly defined levels repeatedly, perhaps between $45 and $52 or any similar range. The boundaries become apparent after several tests. Each time price approaches support, it finds buying interest. Each time it nears resistance, selling appears. This creates the rectangular formation. Second, pay attention to the duration. A genuine accumulation box requires time, typically several weeks to several months, depending on the size of the position being built. Remember this principle. The longer the preparation, the greater the campaign. A 6-week box suggests a moderate position. A 6-month box indicates an enormous accumulation that will fuel a significant advance. Third, watch the volatility within the range. In the early stages, you might see wider swings from support to resistance. As accumulation progresses, the oscillations often become tighter and more compressed. This narrowing action suggests the floating supply is being absorbed. There are fewer and fewer shares available to sell because the operator already owns them. The public makes a critical error during these periods. They grow impatient. They see the stock going nowhere and sell out of boredom or frustration, usually near the lows of the range. Every share they sell is quietly absorbed by the composite operator, who knows exactly what comes next. When you learn to recognize these accumulation boxes, you position yourself alongside the smart money rather than against them. You stop viewing sideways markets as wasted time. Start seeing them as the foundation for every significant move that follows. Now we come to the most revealing aspect of market analysis: volume. Price alone would deceive you. The composite operator is an expert at manipulating price to create false impressions. But volume, when properly understood in relation to price, reveals the truth of what the large interests are actually doing. Let me give you the fundamental principle that will guide all your analysis. Volume represents activity, effort, and the intensity of buying or selling. When you see heavy volume, you're witnessing the transfer of substantial share quantities from one group to another. The critical question is this: who is buying and who is selling? Consider what happens at the lower boundary of the accumulation box near support. The public sees the stock declining and becomes nervous. They remember it dropped here before, and they fear it will break through this time. So they sell. Here's where you must become a detective. If their selling is met with heavy volume but the price refuses to decline further, or worse, it actually reverses upward, what does this tell you? It tells you everything. Heavy volume with no further price decline is absorption. The composite operator is standing there with open arms, buying every share the frightened public throws at them. Think of it like a sponge soaking up water. The selling pressure, volume, is being completely absorbed without the expected result: lower prices. This is one of the most bullish indications you can find. Now observe the opposite condition at the upper boundary of the range near resistance. The stock rallies, and the public becomes excited. They think a breakout is coming and rush to buy. But notice the volume, it's lighter, anemic. The price manages to reach resistance, but on diminished activity. What does this mean? It means the composite operator is not participating. There's no genuine demand at these levels. The operator accumulated what they wanted at lower prices. Why would they chase it higher? This creates the oscillation within the box. Heavy volume absorption near support, light volume rallies to resistance. Then the decline back towards support on the public's disappointment when the breakout fails. As accumulation progresses, watch for this critical shift. Volume should begin to decrease on declines and increase on rallies. Early in the accumulation phase, you'll see heavy volume at the bottom of the range. That's the initial absorption. But as the campaign advances and most of the available supply has been bought, declines occur on progressively lighter volume. There are simply fewer sellers left because the operator already purchased their shares. Simultaneously, rallies from support should show increasing volume. This indicates the composite operator is now supporting the advance, preparing for the eventual markup phase. Here's how you distinguish accumulation from distribution. In accumulation, heaviest volume occurs at the lows with resilience. In distribution, heaviest volume occurs at the highs with weakness afterward. The composite operator buys on weakness and sells on strength, while the public does precisely the opposite. Train your eye to read these volume patterns. They're the footprints of the large interests, and they never lie about their intention. Of all the tactics employed by the composite operator during accumulation, none is more deliberate or more profitable for those who understand it than the spring. This maneuver represents the culminating act of the accumulation campaign, the final shakeout before the stock is ready for its advance. Let me describe what happened. The stock has been trading in its box for weeks, perhaps months. Support has been tested multiple times at, let's say, $47. The public has come to trust this level. Stop-loss orders accumulate just below it, perhaps at $46.50 or $46, placed there by cautious traders who want to protect themselves from further loss. The composite operator knows exactly where these stops are clustered. They can see the order book, they understand crowd psychology, and they know that one final large pool of supply sits just below that support level, waiting to be triggered. So what do? They engineer a deliberate break of support. The stock suddenly plunges through $47 on heavy, sometimes climactic volume. It might touch $45 or even $44. Panic ensues. The stops are triggered. Weak holders who bought during the range throw their shares overboard in fear. The financial press might publish negative news, conveniently timed. I assure you that justifies the breakdown. But here's what you must watch for. How does the stock behave immediately after this shakeout? Does it continue collapsing into new lows? Or does it quickly recover, snapping back above support within the same session or the next day? A genuine spring shows this rapid recovery. The breakdown was false, a trap. The composite operator orchestrated the decline specifically to trigger those stop losses and create panic selling. They absorbed every share that was shaken loose. In a matter of hours or days, the stock is trading back above $47 as if the breakdown never happened. Think about what this accomplishes. First, the operator acquires the last significant block of floating supply. Those stop-loss shares they couldn't coax out through normal range trading. Second, they eliminate the weak holders from the stock. Anyone who sold in panic is now out. The remaining holders have stronger hands because they've been tested and held through the shakeout. Third, and most importantly, the spring signals that accumulation is complete. The operator has accumulated all they need. They've exhausted the available supply. There's no one left to sell. The campaign can now advance to the next phase, markup. How do you use this knowledge? When you see a sharp break of support on heavy volume followed by immediate recovery in strength, don't run for the exits. Recognize it as the highest probability accumulation signal available. The breakdown that looked so frightening was actually the final buying opportunity before the advance begins. The spring is the composite operator's signature. Once you learn to recognize it, you'll see it in virtually every significant accumulation pattern throughout market history. It's their calling card, their final maneuver before they stop hiding and begin marking up their position in earnest. Once the stock breaks out from its accumulation box, many traders assume the opportunity has passed. They watched the entire range unfold, perhaps even identified it as accumulation, but hesitated to act. Now, with the stock trading above resistance, say at $55 after breaking up from a $47 to $52 box, they believe they've missed their chance. This is where understanding the natural rhythm of market campaigns becomes invaluable. The composite operator, having completed accumulation and initiated markup, understands that not everyone was ready to buy during the range. Some supply still exists just above the breakout point, timid holders who bought near the top of the box and are now relieved to get out even. Additionally, early breakout buyers may take quick profit. What happens next is what I call the backing up action, and it represents your last high-probability entry point before the major advance unfolds. After the initial thrust above resistance, the stock will naturally encounter this residual selling pressure. Instead of continuing straight up, it pauses and begins to drift back downward. This is not failure, it's entirely normal and in fact desirable. Watch where it retreats to. The top of the former accumulation box, which was resistance at $52, now becomes support. Here's the critical observation. What is the volume during this pullback? If accumulation was genuine, you should see diminished, quiet volume as the stock backs up. Light volume on the decline tells you there's no real selling pressure. The composite operator isn't selling. The public isn't panicking. It's simply a natural pause, a testing of the former resistance level as new support. This backing up action serves multiple purposes. It allows the operator to absorb that final bit of supply from nervous holders. It shakes out the weak-handed breakout chasers who bought in excitement and now sell on the first sign of weakness. And most importantly for you, it provides one last entry point at favorable prices. Consider the risk-reward proposition at this juncture. You're buying at $52 or $53 just above the former range with support clearly established below you. Your risk is defined and relatively small. If you're wrong and this was an accumulation, the stock will break back into the box and you'll know quickly. But if you're right, the entire projected advance lies ahead of you. Compare this to buying during the range itself when you couldn't be certain accumulation was occurring, or buying on the initial breakout at $55, paying a premium for confirmation. The backing up offers the ideal combination: confirmation that accumulation occurred, the breakout proved it, support clearly established, the former resistance, and favorable entry prices, the pullback, brings you closer to your support level. I've observed this pattern countless times across every market and time frame. After a genuine accumulation campaign, the backing up to the last point of support is almost inevitable. The stock must digest the breakout, test its new support level, and prepare for sustained advance. When you see this backing up occur on light, quiet volume, recognize it for what it is, not a failure of the breakout, but your final invitation to participate in the campaign at advantageous prices. One of the most practical and valuable principles I can teach you is this: the extent of the preparation determines the extent of the move, or stated more precisely, the width of the trading range predicts the minimum vertical distance the stock will travel once markup begins. This isn't mysticism or guesswork. It's the logical consequence of the composite operator's position-building requirements. Let me explain the reasoning. When the composite operator constructs an accumulation box between $45 and $55 a 10-point range, why did they choose this width? Why not accumulate in a tighter 5-point range? The answer is simple: they needed room to operate. A 10-point range allows them to buy substantial quantities over an extended period without exhausting supply too quickly. The operator uses the entire width of the box for their campaign. They buy heavily at the lower end, near $45, absorb supply throughout the middle zone, and even buy on rallies to $55 when they must. The wider the box, the more shares they can accumulate, and the larger their total position becomes. Now think about what happens after accumulation completes. The operator has acquired, let's say hypothetically, 200,000 shares at an average cost near $50. They didn't go through this elaborate, time-consuming campaign to make 1 or 2 points of profit. That wouldn't justify the effort, the capital commitment, or the risk. They need substantial profit to make the campaign worthwhile. This is where the measurement comes in. Take the width of your accumulation box, in our example, 10 points from $45 to $55. The minimum objective once the stock breaks out is to add that same distance to the breakout point. If the breakout occurs at $55, your minimum target becomes $65. Often, the move extends much further, perhaps $75 or $80, but the box width gives you the conservative minimum expectation. Why does this work so consistently? Because the operator's position size demands it. If they accumulated 200,000 shares in a 10-point box, they need at least a 10-point advance to begin distributing that position at worthwhile profits. A smaller move wouldn't provide enough room for them to exit their entire position profitably. Consider also the inverse relationship. A narrow 3-point box suggests limited accumulation and predicts a modest advance, perhaps only 3 to 5 points. The operator didn't build a large enough position to fuel a major campaign, but a 20-point box. That indicates massive accumulation and projects a substantial advance of 20 points or more. I've tested this principle across thousands of charts and countless markets. The correlation is remarkable. A stock that consolidates for 6 months in a $15 range invariably produces a more significant move than one that consolidates for 6 weeks in a $5 range. Time and price range both matter longer. Wider boxes mean larger campaigns. Apply this measurement to every accumulation pattern you identify. When you spot a box forming, measure its width. This tells you 2 things. First, whether the potential reward justifies your risk. A narrow box with limited projection might not be worth your capital. Second, it gives you a realistic target for profit-taking. When the stock reaches your measured objective, watch for signs of distribution because the operator may begin exiting their position. The composite operator operates mathematically and logically. Once you understand their requirements and methods, the market becomes far less mysterious and far more predictable. Gentlemen, we've covered considerable ground today, and I want to ensure you leave here understanding the profound shift in perspective that separates successful speculators from the masses who consistently lose. The accumulation box is not merely a pattern to memorize, it's a window into the very mechanics of how markets truly operate. Every significant advance in market history has been preceded by a period where the composite operator quietly, methodically, and deliberately built their position while the public remained blind to what was happening. You now understand that sideways markets aren't dead zones to be avoided. They're theaters of operation where the real money is being made, just not by those who grow impatient and leave. You've learned to read volume as the language of truth, revealing absorption when price should fall but doesn't, and weakness when price rallies without conviction. You recognize the spring for what it is, not a reason to panic and sell, but the final gift from the operator, one last shakeout that hands you shares at the exact moment accumulation completes. You understand the backing up after a breakout isn't failure but invitation, your last favorable entry point before the major campaign unfolds. And you can now measure these boxes mathematically, projecting minimum objectives based on the width of preparation. But knowledge alone accomplishes nothing. You must now take these principles and apply them with discipline and patience. Study your charts with new eyes. When you see a stock oscillating in a range, don't dismiss it, investigate it. Is volume heavier at the lows with resilience? Are the swings becoming compressed? Is the range wide enough to justify a substantial campaign? The composite operator will continue their campaigns whether you participate or not. The choice before you is simple. Will you continue trading like the public, buying on excitement, selling on fear, confused by every shakeout and fake breakdown? Or will you align yourself with the methods of the large interests, reading their footprint in the volume and price action, positioning yourself alongside them rather than against them? I can teach you the principles, but only you can develop the patience to wait for proper setups, the courage to buy when others are selling in panic during the spring, and the discipline to measure your campaigns and take profits at logical objectives. Remember this above all: the market rewards those who think, who observe, who remain patient through the preparation phase, and who act decisively when the evidence is clear. Everything the composite operator does leaves traces. They cannot hide their buying. Completely heavy volume at support reveals them. They cannot avoid the spring they need to shake out. Final supply exposes them. They cannot escape the backing up. It's the natural rhythm of every campaign. You now possess something invaluable, a framework for understanding market behavior based not on hope, tips, or emotional reactions, but on the logical actions of those who move markets. Use it wisely. Study every accumulation box you encounter. Keep records. Verify these principles for yourself until they become second nature. The markets will provide endless opportunities for those who know how to read them. Your success depends entirely on whether you apply what you've learned today with patience, discipline, and unwavering attention to the evidence before you. The composite operator is out there right now, building the next campaign in some overlooked stock, trading quietly in a box. Will you recognize it? Will you have the patience to wait for confirmation? Will you act when the spring occurs, or will you sell with the frightened crowd? The choice, as always, is yours. But now, at least, you're equipped to make that choice with knowledge rather than ignorance. Go forth and read the markets as they truly are, not as you wish them to be. The rewards will follow.